People keep calling silver the next gold. But that comparison misses the most important point. Silver isn't just a store of value. It's an industrial metal tied directly to the real economy, manufacturing, energy, technology. That single fact changes how silver behaves in every market cycle. Before you buy silver, there's one question you have to answer. Are you betting on financial fear or on economic expansion? Because silver rewards one of those and then punishes the other. In this video, you'll learn 3 things that actually matter. When silver outperforms gold, and when it absolutely doesn't. The exact conditions that flip silver from a safe asset into a risky one. And the 3 numbers that determine whether silver becomes a winning trade or a trap. Before we get into the why, let's look at the what. Here's your scoreboard. The 4 numbers that tell you the state of play for silver at any given moment. Number 1 is the silver price versus the gold price. Not just where silver is today, but how it's moved relative to gold over 1 year and 5 years. This tells you whether silver is gaining ground or falling behind. Number 2 is the gold to silver ratio. This is simply the gold price divided by the silver price. Right now, depending on when you're watching this, it's somewhere in the range of 70 to 90. Historically, it has averaged around 60. When this number is high, silver is relatively cheap compared to gold. When it's low, silver is relatively expensive. Number 3 is real interest rates. We're going to use US TIPS yields as our proxy here. This tells you whether holding non-yielding assets like metals makes sense compared to just holding cash or bonds that actually pay you something after inflation. And number 4 is the US dollar, tracked through the DXY index. A stronger dollar usually puts pressure on commodities priced in dollars. A weaker dollar is typically supportive. Here's the simple truth. If these 4 metrics move in the wrong direction, rates going up, dollar getting stronger, ratio falling, silver can feel less like the next gold and more like a high volatility commodity that just burned a hole in your portfolio. So let's understand why people are excited about silver in the first place. There are 3 main reasons the silver is the next gold narrative keeps coming back. And to be fair, these aren't crazy reasons. They make sense under the right conditions. The first reason is the dual demand story. Let's start with gold. Gold demand comes from 3 main buckets: jewelry, investment demand from individuals and funds, and central bank reserves. Central banks around the world hold gold as part of their foreign exchange reserves. That's a structural pillar of demand. Now look at silver. Silver gets investment demand too. People buy silver coins, silver ETFs, and silver bars. But here's the difference. Roughly half of silver demand comes from industrial applications, electronics, medical equipment, and increasingly, solar panels. So silver has 2 engines. It's a monetary metal like gold, but it's also an industrial commodity. That second engine can provide a tailwind that gold doesn't have. According to data from the Silver Institute and their annual World Silver Survey, industrial demand has been a growing portion of total silver demand, especially over the past decade. The second reason is energy transition exposure. Silver is used in the manufacturing of solar photovoltaic cells. Each solar panel contains a small amount of silver in its conductive paste. Multiply that by the millions of panels being installed globally, and you get meaningful demand. According to the International Energy Agency, solar PV has been the fastest growing source of electricity generation for years. And if that build-out continues, which most projections suggest it will, that's a tailwind for silver demand that simply doesn't exist for gold. Now, is solar going to make silver prices explode? Probably not on its own, but it provides a structural demand story that gold doesn't have. It's an extra engine. The third reason is purely mechanical. Market size amplifies moves. The silver market is much smaller than the gold market. That means when capital flows in or out, price moves get amplified. Silver is more volatile in both directions. When the cycle is right, silver can outperform gold by a significant margin. Look at any major precious metals bull market, and silver usually ends up rising more than gold in percentage terms. But when the cycle is wrong, silver can drop faster and harder than gold. This is the leverage you get from a smaller market. It's not free. It comes with risk. Okay, so we've established the bull case. Now let's talk about how this actually works mechanically. What drives silver and how does it differ from gold? I think about it as 3 engines. All 3 need to be working in silver's favor for the next gold thesis to play out. The first engine is interest rates, specifically real interest rates. When real interest rates rise, that means you can earn a decent return on cash or bonds after accounting for inflation. In that environment, holding metals becomes less attractive because metals don't pay you anything to hold them. There's no yield, there's no dividend. You're just sitting there hoping the price goes up. So rising real rates are usually a headwind for both gold and silver. They increase the opportunity cost of holding metals. When real rates fall, or when inflation is running hotter than nominal rates, metals tend to do better because there's less competition from yield-bearing assets. The World Gold Council has published extensive research on this relationship for gold, and silver tends to follow the same dynamics, often with more volatility. The second engine is the US dollar. Silver, like most commodities, is priced in dollars. When the dollar strengthens, meaning the DXY goes up, it typically puts pressure on commodity prices because it takes fewer dollars to buy the same amount of stuff. When the dollar weakens, commodities generally get a tailwind. The same ounce of silver becomes worth more in dollar terms. This isn't a perfect relationship, but over time, a weaker dollar tends to support silver, and a stronger dollar tends to pressure it. If you go back and look at the major silver rallies, 2010 to 2011, the early 2020s, you'll often find them coinciding with periods of dollar weakness or at least dollar stability. The third engine is growth and manufacturing, and this is where silver really diverges from gold. Silver cares about industrial demand. About half of silver demand comes from industrial uses. That means silver is sensitive to the manufacturing cycle in a way that gold simply isn't. When manufacturing is expanding, when global PMI is above 50 and trending up, silver can get a bonus tailwind that gold doesn't need. Factories are buying silver, solar panels are being made, electronics are being produced. But when manufacturing slows down, when you're in a recessionary environment, that industrial demand can soften and silver loses one of its engines. Gold doesn't have this problem as much. Gold demand is more stable across economic cycles because it's not really consumed by industry the way silver is. So here's the key insight. For silver to truly outperform gold, you need all three engines firing. You need real rates low or falling, you need the dollar stable or weak, and you need manufacturing and industrial activity to be strong. If you only get 2 out of 3, silver might still do okay, but it probably won't dramatically outperform. And if all 3 are working against you, that's when silver becomes a painful trade. Let's go a level deeper because this is where people get burned. Silver often gets marketed as cheap gold. You'll hear things like, gold is expensive, but silver is undervalued. Just look at the ratio. But that framing is misleading. Here's a more accurate way to think about it. Gold equals financial insurance. It's what you hold when you're worried about currency debasement, financial system stress, or geopolitical chaos. Central banks hold it. It's nobody's liability. It's the ultimate defensive asset. Silver equals insurance plus a cyclical growth bet. You get some of that monetary metal characteristic, but you're also betting on industrial demand, on manufacturing, on economic activity. So here's the trap. Imagine you buy silver expecting a crisis rally. You think everything is about to fall apart, so you load up on silver thinking it's going to moon like gold does in a crisis. But what if the crisis is deflationary? What if it's a demand destruction recession? Factories slow down. Industrial demand for silver drops. The dollar might strengthen as people flee to safety. In that scenario, gold might hold up reasonably well because it's pure financial insurance. But silver can lag badly because it has lost one of its engines. We saw this in 2008. During the acute phase of the financial crisis, both gold and silver sold off, but silver dropped harder. It took silver longer to recover because the industrial picture was so weak. So silver isn't just cheap gold. It's a more complex instrument. And that complexity can work for you or against you depending on the environment. Now let's steelman the other side. Here are 3 structural reasons why silver might not be the next gold, not just cyclically, but structurally. The first point is that central banks buy gold, not silver. Central bank gold buying has been one of the biggest stories in the precious metals market over the past decade. Countries like China, Russia, India, Turkey, and Poland have been steadily adding to their gold reserves. This is a structural pillar of demand for gold. It's not speculative, it's strategic. Silver doesn't have this. No major central bank holds silver as a reserve asset. That means silver lacks one of gold's most important demand floors. The second point is substitution and thrifting. Here's something people don't talk about enough. Industrial consumers don't like high prices. If silver becomes too expensive, manufacturers have strong incentives to reduce the silver content per unit or substitute alternative materials where possible. This is called thrifting. Solar panel manufacturers, for example, have already been working on ways to reduce silver loading per cell. If silver prices spike, that research accelerates. This creates a kind of ceiling on silver demand at high prices that gold doesn't face as much. The third point is storage friction. This one is practical, but it matters more than people think. Silver is bulky. $1 million of gold weighs about 44 pounds. $1 million of silver weighs over 2,000 pounds. You need more vault space, more security, and more logistics. For retail investors buying a few coins, this doesn't matter. But for institutional investors, pension funds, or sovereign wealth funds that might want to deploy serious capital, the storage friction of silver relative to its value is a real barrier. This is one reason why silver doesn't attract the same institutional flows that gold does. Let's put this all together with 3 scenarios. In the best case for silver, real rates fall, or inflation stays persistently higher than nominal rates. The dollar weakens or at least stops strengthening. Manufacturing and solar demand stay strong. In this environment, all 3 of silver's engines are firing. The monetary metal bid is there because rates are low. The commodity bid is there because industrial demand is strong, and the dollar isn't fighting you. The result is that silver often beats gold, sometimes by a lot. The gold-to-silver ratio compresses. This is the environment silver bulls are hoping for. In the base case, rates drift down slowly but not dramatically. Growth is okay but not booming. The dollar is range-bound. The result is that silver rises. What to watch? So what do you actually watch if you're interested in this trade? If you follow only 3 things, follow these. Number 1 is real yields. Watch the US 10-year TIPS yield. When it's rising, that's usually a headwind for metals. When it's falling, that's usually supportive. Number 2 is DXY. A strong dollar is usually a problem. A weak dollar is usually helpful. Number 3 is manufacturing PMI. This tells you whether silver's industrial engine is engaged. Global PMI above 50 and trending up? That's good for silver. Below 50 and falling? That's a warning sign. As an optional bonus, watch the gold-to-silver ratio as a sentiment gauge. It's not a law, but extreme readings can sometimes indicate when the market is stretched in one direction. But it's choppy. There will be periods where it outperforms gold and periods where it lags. You make money, but you also go through drawdowns that test your conviction. This is probably the most likely scenario in any given year. In the worst case for silver, a recession hits and credit tightens. The dollar strengthens as a safe haven. Industrial demand weakens materially. The result is that gold holds up better because it's pure financial insurance. Silver drops harder because it loses its industrial engine right when you need it most. The gold-to-silver ratio expands. This is where the cheap gold narrative becomes a trap. So here's the bottom line. Silver can be the next gold, but only in a specific environment. You need easier money, a weaker dollar, and decent economic growth for all 3 of silver's engines to fire at once. If you get that, silver can outperform gold meaningfully. If you don't, silver becomes a more volatile, more frustrating version of gold that can leave you questioning your thesis. Know what you're buying, know what conditions you need, and watch the 3 numbers that matter most. If you found this useful, let me know in the comments. Drop a country or a topic you want me to cover next, whether that's a currency crisis, interest rate mechanics, or how bond markets actually work. And I'll do the same style of breakdown. Thanks for watching. I'll see you in the next one.